Michael Oliver has been warning investors for years, but now his message has reached a fever pitch. The founder of Momentum Structural Analysis, a man who has spent over 4 decades studying the hidden patterns beneath price movements, is telling anyone who will listen that silver is about to do something extraordinary. Not just another rally, not just another cycle, something that happens once in a generation. And his message is simple: buy silver before it is too late. To understand why Oliver is so convinced, you have to understand how he thinks. Most analysts look at price charts. They draw lines, identify support and resistance levels, and try to predict where prices will go based on where they have been. Oliver does something different. He looks at momentum. Not the momentum indicators you see on most trading platforms, but a proprietary system he developed over decades that tracks the underlying structural forces driving markets. He compares it to building a house with a yardstick that keeps changing length. When you measure markets in dollars, you're measuring with a unit that constantly loses value. The dollar today is worth a fraction of what it was worth in 1980 or 2011. So when people say silver hit $50 in 1980 and again in 2011, Oliver says that is meaningless. Adjust for the expansion of the money supply, adjust for the debasement of the currency, and silver at $50 today is nothing like silver at $50 in those earlier eras. In real terms, silver should already be trading in the hundreds. This is the foundation of his entire thesis. We are living through the most aggressive monetary expansion in human history. Central banks around the world have printed trillions upon trillions of dollars, euros, yen, and yuan. They have pushed interest rates to zero and below. They have bought bonds, stocks, and in some cases, even equities directly. The money supply has exploded in ways that would have seemed unthinkable just 2 decades ago. The numbers are staggering. The Federal Reserve S balance sheet has exploded from under $1 trillion before the 2008 financial crisis to over $8 trillion at its peak. In 2020 alone, during the pandemic, the United States increased its money supply by roughly 25% in a single year. A quarter of all dollars in existence were created in 12 months. Think about that. Think about the implications. And all of that new money has to go somewhere. For years, it went into stocks, it went into bonds, it went into real estate and cryptocurrencies and all manner of financial assets. But Oliver believes we are reaching the end of that era. The everything bubble, as some call it, is showing cracks. And when it breaks, all that money is going to need somewhere to go. Oliver believes it is going into gold and silver. The numbers support his case. As of late December 2025, silver is trading around $74 to $75 per ounce. That might sound high if you remember silver at $20 or $25 just a couple of years ago, but consider the context. Silver started 2025 at around $30. It has gained over 150% in a single year. It has broken through resistance levels that held for over a decade. It has smashed through the $50 ceiling that marked the highs in 1980 and 2011. And according to Oliver, this is just the beginning. He points to what he calls the most important chart in the world. It is not a chart of silver or even gold. It is a chart of gold relative to the S&P 500. For over a decade, stocks outperformed gold. The ratio of gold to stocks was in a downtrend, meaning stocks were the place to be. But that trend has broken. Gold has decisively broken out against the S&P 500, signaling what Oliver believes is a generational shift. Money is leaving paper assets and flowing into hard assets. This is not a trade. It is not a hedge. It is a fundamental reordering of where capital wants to be. And if gold is breaking out against stocks, silver is poised to break out against gold. This brings us to the gold-silver ratio, another key element of Oliver's analysis. The gold-silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged around 60 to 67 to 1, but in recent years, it has often been much higher, sometimes exceeding 80 or 90 to 1. This tells you that silver is cheap relative to gold. And when that ratio starts to collapse, when silver starts catching up to gold, the moves can be explosive. Oliver has seen this pattern before. In the late 1970s, silver outperformed gold by a massive margin as the ratio collapsed. The same thing happened in 2010 and 2011. Now he sees the setup forming again. The ratio is breaking down. Momentum is shifting. Silver is about to go on a tear that will dwarf anything we have seen so far. But why silver specifically? Why not just buy gold and call it a day? Oliver explains that silver has unique characteristics that make it especially explosive in certain environments. Gold is primarily a monetary metal. Central banks hold it. Wealthy individuals hold it. It is the ultimate store of value. Silver is different. Yes, it has monetary properties. Yes, it has been used as money for thousands of years. But silver is also an industrial metal. It is used in solar panels, electric vehicles, electronics, medical devices, military applications, and countless other industries. This dual nature creates interesting dynamics. When financial demand for silver rises, At the same time as industrial demand, you get a perfect storm. Supply cannot keep up, deficits emerge, and prices go vertical. The supply situation for silver is critical to understanding Oliver's urgency. Unlike gold, which is primarily hoarded and recycled, silver gets consumed. It gets used in products and often cannot be economically recovered. The above-ground stockpiles of silver have been depleted over decades. Meanwhile, mine supply has been stagnant or declining. The world has been running a structural deficit in silver for years, meaning demand exceeds supply. Estimates for 2025 suggest this deficit could be anywhere from 117 to 149 million ounces. That is a massive shortfall, and it is happening at a time when demand is surging from multiple directions. Consider solar energy alone. The world is building out renewable energy infrastructure at an unprecedented pace. Solar panels require silver, a lot of it. As more countries push to decarbonize their economies, demand for silver from the solar industry is expected to grow exponentially. Electric vehicles are another major source of demand. They use significantly more silver than traditional internal combustion engine vehicles. Then there is electronics. Every smartphone, every computer, every piece of modern technology contains silver. And now we have the defense and military sector ramping up demand as geopolitical tensions rise around the world. Silver has recently been designated as a critical mineral by the United States government, recognizing its strategic importance. This is not a metal that is going away. This is a metal that the modern economy cannot function without. Oliver's momentum indicators are flashing signals he has rarely seen in his career. He describes the current setup as a compression breakout. Silver spent over a decade trapped in a range, suppressed by what many in the precious metals community believe was deliberate manipulation in the futures markets. Large short positions held prices down even as physical demand grew. But compression creates energy. The longer a market is held down, the more violent the eventual release. Oliver compares it to a coiled spring. Press it down long enough and hard enough, and when it finally releases, it does not just return to normal. It explodes upward with tremendous force. That is what he believes is happening now. The breakout above $50 was the key moment. That level had held as resistance for over 40 years. It represented the peak of the 1980 mania and the peak of the 2011 rally. Breaking through it was not just technically significant, it was psychologically transformative. It told the market that the old rules no longer apply. Silver is not going back to $20. It is not going back to $30. Even $50, which seemed impossibly high for so long, is now likely to become a floor, not a ceiling. Oliver has been willing to put specific numbers on his projections, something he does not always do. For the first half of 2026, he sees silver reaching $100 to $150 per ounce. By late 2026, he believes $200 is achievable. And in the longer term, he talks about silver entering a new price reality where prices far exceed anything we have seen before. These numbers might seem outlandish if you're used to thinking of silver as a $20 or $30 metal. But Oliver points out that when you adjust for currency debasement, when you account for the trillions in newly created money sloshing around the global financial system, these targets are actually quite conservative. He also emphasizes that this is not just about silver in isolation, it is about a broader shift in the financial system. The era of fiat currency dominance may be coming to an end. Central banks around the world are buying gold at record rates. Countries like China and Russia have been steadily increasing their gold reserves for years. Even smaller nations are recognizing the importance of holding hard assets in an uncertain world. There's talk of gold-backed currencies, of a return to some form of sound money. Oliver believes we are witnessing the early stages of a monetary reset that could reshape the global financial system. And in that environment, precious metals are not just an investment, they are a necessity. The mining stocks are another area Oliver highlights with particular enthusiasm. Gold and silver miners have lagged the metals themselves during this rally. This is not unusual in the early stages of a precious metals bull market. Investors first pile into the metals, seeking safety and liquidity. Only later do they recognize the leverage that mining stocks offer. A gold miner does not just benefit from higher gold prices. Its profit margins expand dramatically as the price of gold rises while its costs remain relatively stable. A miner that was barely profitable at gold $2,000 becomes wildly profitable at gold $3,000 or $4,000. The same applies to silver miners, perhaps even more so given silver's greater volatility. Oliver believes the mining stocks are set for what he calls a violent catch-up phase. He has mentioned that silver miners could potentially double relative to gold during the next phase of this bull market. For investors willing to accept the added risk, the mining sector offers the potential for truly life-changing returns. Of course, mining stocks come with their own set of challenges. Political risk, operational risk, management quality, and jurisdiction all matter. But for those who do their homework and select quality companies, the rewards could be extraordinary. What about the skeptics? There are always those who doubt. They point to silver's history of false breakouts and crushing declines. They remember 1980 when silver crashed from $50 to below $5. They remember 2011 when silver fell from nearly $50 to the low teens. They worry that this rally is just another mania destined to end in tears. Oliver has heard all of these objections. He does not dismiss them. He acknowledges that silver is volatile, that it can and will have sharp corrections along the way. But he argues that the structural setup this time is fundamentally different. In 1980, the silver spike was driven largely by the Hunt brothers attempting to corner the market. It was a speculative frenzy that collapsed when the rules were changed against them. In 2011, silver rose on quantitative easing hopes, but fell when the Federal Reserve stepped back and the dollar strengthened. This time, Oliver argues, the drivers are much more profound. The money supply expansion is not temporary. It is permanent and accelerating. The industrial demand is not going away. It is growing structurally. The supply deficits are not a one-time occurrence. They are baked into the market for years to come. And the breakdown in confidence in fiat currencies is not a fringe concern. It is becoming mainstream. Central banks themselves are telling you something by their actions. When the institutions that create fiat money start hoarding gold, they are sending a signal. They are hedging against the very currencies they issue. This is not conspiracy theory. This is observable behavior. And as this realization spreads from central banks to sovereign wealth funds to institutional investors to retail investors, the demand for precious metals is only going to grow. Oliver's message carries urgency because he believes the window is closing. Yes, silver is already up over 150% this year. Yes, it is trading at all-time highs. But in his view, this is still early. The really big moves happen fast, and they happen when most people are not positioned. By the time the average investor realizes what is happening, by the time the mainstream financial media catches on, by the time your neighbor starts asking about silver, the easy gains will be gone. The time to buy is not when it feels comfortable. The time to buy is now, while doubt still exists, while many are still on the sidelines. He points to the recent pullbacks as opportunities. Silver does not go straight up. It never has. There will be corrections, sometimes sharp ones. Oliver views these as bear traps designed to shake out weak hands before the next leg higher. The institutions know how to play this game. They push prices down, trigger stop losses, create panic, and then buy up the cheap shares and ounces from those who sold in fear. If you understand this game, you can use it to your advantage. You can buy the dips instead of selling them. You can accumulate on weakness instead of panicking. The physical market is sending its own signals. Reports have emerged of major corporations prepaying for silver supply, locking in future deliveries at today's prices. This is not typical behavior. It suggests that sophisticated industrial buyers are worried about availability. They are willing to pay a premium and commit capital up front just to ensure they can get the metal they need. When companies start competing for physical supply, when the inventory at exchanges starts to dwindle, when premiums for physical metal over spot prices start to rise, these are all signs of a tightening market. These are all signs that the paper price you see on your screen may not fully reflect the reality on the ground. China is a particularly important factor in the current silver market. Reports indicate that silver has hit record prices in China, with physical supply becoming increasingly tight. China is both a major consumer and producer of silver. When Chinese buyers start bidding aggressively for metal, it has global implications. There are even reports of a physical shortage developing, with the Shanghai market showing stress. This is significant because China has historically been a source of silver supply for global markets. If that flow reverses, if China becomes a net importer competing for global supply, it adds another bullish factor to an already bullish setup. Silver exchange, traded funds offer convenience and liquidity. You can buy and sell with a click in any amount from your phone. No storage concerns, no security worries, but you do not own physical metal. You own shares in a trust that claims to hold metal in a vault somewhere. There is counterparty risk, the risk that in a true crisis, paper claims on silver may not be honored the same as physical ownership. There's also the risk of redemption suspensions or forced cash settlements. Mining stocks offer leverage to silver prices, but come with company-specific risks, as discussed earlier. Exploration companies offer the most upside, but also the most risk. These are companies without producing mines, betting on discoveries. Producers are safer, but offer less explosive potential. Royalty and streaming companies offer a different risk-reward profile, providing financing to miners in exchange for rights to future production at discounted prices. There is no one right answer. It depends on your goals, your risk tolerance, your time horizon, your personal situation. Many experienced precious metals investors hold a combination, a core position in physical metal for security, some ETF exposure for liquidity, and some mining stocks for leverage potential. The geopolitical dimension cannot be ignored. The world is becoming more unstable, more fragmented, more uncertain. Conflicts in multiple regions are driving demand for safe haven assets. The weaponization of the dollar through sanctions has caused many nations to seek alternatives. De-dollarization is no longer just a theory discussed by academics. It is a policy being actively pursued by major economies. In this environment, gold and silver serve as neutral assets, not tied to any one country or government. They cannot be frozen, sanctioned, or inflated away. This makes them attractive not just to individual investors, but to nations themselves. Oliver has said that this is not just another boom-bust cycle, it is the end of a fiat era. That is a bold statement, and only time will tell if he is right. But consider what it would mean if he is even partially correct. If we are indeed witnessing a fundamental shift in how the world thinks about money and value, the implications are enormous. Those who position themselves correctly could see their wealth preserved and multiplied. Those who ignore the signs could see their purchasing power erode as currencies continue to lose value against real assets. The silver story is also an American story. Silver has deep roots in American monetary history. The country was founded on a bimetallic standard of gold and silver. Silver coins circulated as money for most of American history. The phrase sound as a dollar originally referred to the silver content in the currency. When that link was severed, when money became purely paper and then purely digital, something was lost. Now, as confidence in that system wanes, there is a return to the original understanding. Silver is money. It has been money for 5,000 years, and it is reasserting that role now. For those considering an investment in silver, there are multiple ways to gain exposure. Physical silver in the form of coins and bars offers the most direct ownership. You hold it in your hands. No counterparty risk, no dependence on any financial institution. The downside is storage and security costs, plus the premiums charged by dealers. Silver exchange, traded funds offer convenience and liquidity. You can buy and sell with a click. But you do not own physical metal. You own shares in a trust that holds metal. There is counterparty risk, and in a true crisis, paper claims on silver may not be honored the same as physical ownership. Mining stocks offer leverage to silver prices, but come with company-specific risks. Exploration companies offer the most upside, but also the most risk. Producers are safer, but less explosive. Royalty and streaming companies offer a different risk-reward profile. There is no one right answer. It depends on your goals, risk tolerance, and time horizon. Oliver himself does not typically give specific investment advice. His business is analysis, not recommendations. But his message is clear. The opportunity in silver is historic. The setup is rare. The potential is enormous. And the window may not stay open forever. He has been studying markets for over 40 years. He has seen bull markets and bear markets. He has seen manias and crashes. And he is telling anyone who will listen that what is happening in silver right now is special. It is not hype. It is not wishful thinking. It is based on structural momentum signals that have been building for years and are now breaking out. The question every investor must ask themselves is whether they are positioned for what is coming. Not what they hope will happen, not what they fear will happen, but what the evidence suggests is likely to happen. The evidence, according to Oliver and many others in the precious metals space, points to significantly higher silver prices. $100, $150, $200. These numbers that seemed like fantasy a year ago are now being discussed as realistic targets by serious analysts. This is not to say there are no risks. There are always risks. Silver could face regulatory changes. Governments could intervene in markets as they have before. Industrial demand could slow if the global economy enters recession. Substitutes could be found for some silver applications. Mining supply could increase if new projects come online. The dollar could strengthen unexpectedly, pressuring metal prices. All of these are possible. All of these should be considered. But weigh them against the bullish factors. The structural deficit, the industrial demand growth, the monetary debasement, the geopolitical uncertainty, the momentum breakout, the gold-silver ratio compression. On balance, the case for higher silver prices appears compelling. Michael Oliver has been right about major market moves before. He anticipated the crash of 1987. He has called numerous turning points in gold and silver over the years. He is not always right, no analyst is, but his track record commands respect. When someone with his experience and methodology issues urgent warnings, it is worth paying attention, not blindly following, but seriously considering. The next few months and years could be transformative for silver investors. Those who bought at $20 or $30 and held through the volatility are now sitting on tremendous gains. Those who waited, who doubted, who procrastinated, are watching from the sidelines wondering if it is too late. Oliver says it is not too late. The move to $100 has not happened yet. The move to $200 has not happened yet. The real explosive gains may still be ahead. But the time to position is now, not tomorrow, not next month, not when it feels safe. Now. In the end, investing is about managing probabilities and positioning for outcomes. No one knows the future with certainty. But by studying history, understanding market structures, analyzing supply and demand fundamentals, and listening to experienced voices like Michael Oliver, we can make informed decisions. The decision to buy silver is not just a financial choice. It is a bet on a certain view of the world, a view that says fiat currencies are being debased, that hard assets will outperform, that industrial demand for silver will continue to grow, and that the next few years could see a historic repricing of this ancient metal. Michael Oliver is making that bet. Many others in the precious metals community are making that bet. Institutions and central banks are making that bet. The question is whether you will join them. The opportunity is here. The evidence is mounting. The momentum is building. Silver is breaking out. And the message from one of the most respected technical analysts in the industry is clear. Buy silver before it is too late. The clock is ticking. The window is open. But it will not stay open forever.